Good afternoon, everyone. Thank you for joining us today. We hope you are doing well and staying safe. My name is Maria Asher, and I'm part of the investments team that manages the Westwood Select strategy. Today, we wanted to discuss our outlook for the economy as we enter in the second half of 2020. For that, we have Leah Bennett and Adrian Helford joining us on the call as well. Leah is the president of Westwood Wealth Management Houston and the lead PM on Select Strategy. Adrian is a senior vice president and the director of multi-asset portfolios here at Westwood. Hi, Leah and Adrian. How are you all doing?
Hi, Maria. It's great to see you.
So my first question is for both of you, and I wanted to get your opinion on the markets. So basically, from March 23rd, when the markets reached its lows, we have seen about 40% increase in S&P 500 index. At the same time, especially recently, we have also seen significant increase in coronavirus cases. How do you think the market is reflecting these risks, and how concerned are you?
I think the market is still reflecting some of these risks, and we have seen that volatility. So let's go back for a second and say, well, number one, we're a little over halfway in 2020. We have certainly had enough excitement for a full decade, it feels like from my side. The outlook pre-COVID-19 was truly low interest rate policies, high consumer savings rates, long-term muted growth, because recall, we were in the longest cycle in history, but not the greatest cycle, as I've spoken about before. Muted growth, muted inflation. Without that bubbly investor leverage that often leads to downturns like we saw in 2006 and 2007. We were looking for, the broad market was looking for consumer sentiment and corporate spending to start to pick up to help drive a better 2020. Now we saw that, all the way down to a 30% drop in the S&P 500 from the beginning of the year when the world was going to end. What we have seen is some rationality come back. The rationality is, well, the world's not going to end. Our complete way of life is not going to change. Some degree of consumption and corporate spending that will drive our economy will come back. And of course, we'll talk much about this, but extraordinary government stimulus has pushed us, considerably back in terms of pushing interest rates down and providing fiscal stimulus, which will continue. So right now I do look and I see earnings multiples that are very high, but they are reflective of low policy rates and this potential rebound in spending activity, at least to some degree. So there's some rationality coming in. The second question is a good one of, are we properly reflecting the risk now that we could see, or maybe we're mired in a first wave, or we could see a second wave, whatever it is, that there's still the base effect of us as a 75% consumption economy are still being heavily impacted by this. Are we reflecting the risk that of a continuation of this? Well, interest rates, I would say, certainly are. The nominal U.S. Treasury yield is still considerably sub 1%. And if you look at ex-inflation, so what are called real yields, those are considerably negative. And that's reflective of an expectation of lower growth for the longer term. The corporate bond market is still providing some excess compensation, we do believe, for the possibility of heightened defaults. And the U.S. central bank is committed to going out and stopping some of that in high grade areas of actual buying corporate bonds onto their balance sheet. I'd say, the equity markets are probably the area where there's the least reflective of the downside risk. There is some upside capability. The downside protection is a little less so, but that also means, as I'm sure Leah would talk about, there's some capability in the sectors themselves and some rotations for where there's better symmetric reward.
Yeah, I think those are some great points, Adrian. And I hear a lot from clients. They ask the question, how is the market doing so well, given all the risks that are out there? And I think it really depends on how you define the market. I think that's one of the big questions that we need to ask ourselves. So if you think about all the major indices, their market cap, they're outsized by their market cap. So if you think about Microsoft and Amazon and Apple, they are so large now from a market cap perspective, they have an outsized impact on the major indices. So if you go back, just to throw out a few statistics, if you look at the 12 months ended 6/30 as an example, 105% of the return of the S&P 500 has come from the tech sector. So we just have a very narrow market. And of course, those companies are doing very well in this remote type of environment. They benefit from what's happened, which is great, but the valuations are also very high versus other sectors that are out there. And again, if you take those top 5 stocks that are in the S&P, those tech stocks, they now comprise 25% of the S&P 500, and this is the most concentrated the S&P 500 has been in over 50 years. And so that's something to definitely keep in consideration. If you go back and look at other sectors, so for example, if you look at financials, and there's definitely a lot of concern around the financials, as we go through this startup and have starts and fits, we've certainly seen some pullbacks, something that's close to our heart in Texas and in Florida and Arizona and some of these other states, as we've not been able to restart as quickly as people thought. There are concerns around the financials. What do credit cards look like? What do mortgages look like? So if you look at financials, they're trading at, on average, 1.1 times book versus historically where they've traded, which is around 1.7 times book. So you'd certainly see nice discounts there, and in other sectors as well, if you look at consumer discretionary and some other areas. And in fact, if you look at the unweighted return of the S&P 500, it's still down about 10% for the year versus the S&P 500. If you fully look at it on a cap weighted basis, it's down about 1.5% for the year. So I think you've got to be able to dig down a little bit to see where there is value.
Thank you so much, Leah and Adrian. And Adrian, just to follow up on that, why do you think the market has been so resilient?
Interesting question. I mean, certainly looking at February and March, the market was not resilient. That was wholesale. The world has changed. Things are going, our way of life is going to change. So let's look and say, well, what's the difference between then and now? That we have heightened incidence of coronavirus. It's not only still with us, but it's in increasing numbers with us. Yet the equity markets keep going up, and so that's the crux of your question. Well, activity has returned somewhat, in part, I'm sure, because of just lockdown fatigue. You get tired of your family at home, and then the other part, of course, would be safety measures put in place. So businesses don't just sit still; they do look for new ways to operate in a differentiated environment. So this is what Leah and I do every day, is look at businesses to say, how are they going to adapt to an adapting environment? This one is certainly a large change in the environment that could be with us for a while. And some businesses, restaurants, cruise lines, others that we know are heavily impacted, are looking at ways to establish some level of consumption back to them. The second, and probably the number one response should be, what's changed since then is that the governments and the central banks have drawn a bright line under valuations. They have said, we are going to be supportive of interest rates, of equity markets. We recognize the wealth effect that your real estate valuation has, that your 401k portfolio has, that the protectiveness that your job has from the fiscal element. And that's been the number one thing. Is what's changed is we now understand that the government and the central bank are going to be there for us should we hit another big downdraft.
Thank you so much. That makes a lot of sense. So let's talk about the bear market. And the next question is for both of you. So in March, we basically saw US indices entering the bear market in the fastest, like in less than 16 days. What factors do you think can cause us to enter another bear market?
Yeah, so definitely what I watch closely, as well as Adrian, something I know that's near to his heart as well, is credit, the health of the credit markets. So if you look at as we've gone through this slow startup, any company that has debt has really struggled through this period. So far we've had 23 publicly traded retailers and restaurants declare bankruptcy. And some of the better well-known names are Hertz, J. Crew, Men's Warehouse. But I think there still are quite a few companies that do have a lot of leverage. And I think that's something I definitely watch closely. is if we continue to see a spike in bankruptcies, you have the potential for credit to seize. Now, as Adrian mentioned, the Fed is doing everything it can to keep the credit markets loose, which is great. So we've been very proactive and hopefully taken a lot of preventative actions to make sure that doesn't happen. But I think that's a key criteria. And I think also what you have to look at in an environment like this, there are a lot of risks, as we've talked about. And so I think focusing on companies that have really strong balance sheets, that have really nice cash flow. And this is part of the reason actually that technology has done so well, is technology fits this kind of profile. But you want to make sure that you continue to own companies like that, so that if we do hit an air pocket and get into a period where we have a downdraft in the markets, that you are protected.
Yeah, and certainly that's a good point. I would add to that and say, we often talk about and look at what's going to lead to a resumption in a bear market or recessionary activity that the markets will underprice. Really, to me, there's three other things. The first is just mention that a recession never just kind of rolls and materializes. It's always kicked off by something. And this may just be the something that then leads to the belt tightening. If for today, doctors came out and said, well, gosh, you take 3 aspirin and suddenly coronavirus goes away. Funnily as that sounds, I'd conjecture that most people are still a little bit of belt tightening while they look around them and themselves and say, well, how bad is this going to be? Why don't I just wait before I institute that big new project on the house or buy that new fancy car and see if businesses are going to come back? So the impact has happened. We possibly have had an event that has kicked off a longer term vicious cycle, for which that's, I do believe that is a case for which the central bank and government are actively thinking that and trying to break that quickly, and they may succeed in doing so. The second is, of the impact of this kind of goes back to your question around resilience of, when we've had heightened coronavirus incidents pick up, we still have seen resilience, in part because people are now looking to the future. We're now having second quarter earnings that are coming in, and while it is impactful, I think a lot of the market is saying, we know it's going to be negatively impacted. We know there's going to be trouble. Let's look to 2021. Just don't mess with that view that by mid 2021 there's going to be a vaccine. That would be a concern for the markets of something that says, oh gosh, it's going to take longer than we think to have a solution available that will get people back out into the markets. The last is, of course, interest rate policy being very important. And if we were to see a rise in especially short-term interest rates, that would lead to a large downturn because of that stimulus. I think that's self-reinforcing, almost because I'm making that statement and that's controlled by Chairman Powell, who understands that dynamic, then that's something that won't happen.
Thank you so much, Leah and Adrian. That makes a lot of sense. So let's talk about elections. This is a question that's been on top of our clients' minds. If you look at the recent election polling, Vice President Biden is leading President Trump even in swing states. So what do you think, or how do you think the markets will behave if come November, Vice President Biden gets elected?
Well, it certainly will be a big shift for us as far as our market-friendly behavior from a government perspective, and a lot of the headlines will be around taxes and the response on taxes. Especially, I'll just key in on one of the bigger headline policies has been the rise in the corporate tax rate from 21 to 28%, suggested by him, and even suggested that that would happen even as markets have not fully recovered. We'll see how that would be received. Now, there are meaningful offsets to things like this that would support markets on the other side. You look down to the redistribution of income to lower and middle income participants. Whether you think that's good or bad and the politically charged nature of it, it does mean there could be an effect on higher aggregate demand that will offset at least some of the corporate tax rate impact that companies will feel. Of course, that would come with broader healthcare coverage, the boost in infrastructure spending as well, which we're already seeing a preface to that in Congress that is looking before the August recess to garner another $1 trillion plus package in fiscal responsibility for us. The last bit that is, certainly last but not least, is a potential de-escalation in the U.S. and China tariffs. And where I've seen estimates and looked at estimates that are the corporate tax rate rise of between 9 and 11% on an earnings basis, the drop in the tariff could almost fully offset that. Now we'll see. So the second question is, because we're pretty heavily pricing of the market the potential for a Biden election at this point. Granted, lots of things change, as we know from the 2016 election. Lots of things change very quickly, so it's very hard to speculate on an election now. But there's already the look towards Congress as well. And could we have not just a Biden election, but what happens with Congress? Could we have a full sweep? The outcomes are very different. Trump, Biden, then Biden plus a full Democratic sweep. That middle path might be the most market appreciative of all of those, where with Biden, then maybe you get the infrastructure spending, maybe you get some of the China tariffs rolled off. Maybe with a Republican-controlled Congress, you get some controls on how much that infrastructure spending, and especially on that corporate tax rate. So you get some of the best of the stuff that would be market appreciative, and some controls on things that would be negatively impacting the market. Those are the scenarios that we are looking at.
Yeah, I think it's interesting. So if you think back to February, which seems like an entire lifetime ago, when Biden won on Super Tuesday, which was a big surprise, the market actually rallied substantially the next day. And again, when you're talking about politics, you have to be analytical, and it's not personal preferences or anything along those lines. But the market basically perceived that Biden is more of a moderate, and the reaction again was very positive, which is encouraging about what might happen if he were to win. Now, I think the things that Adrian mentioned that we really have to think about in particular are the impact to taxes. And Adrian mentioned corporate taxes. Certainly, there's the possibility that he rolls back, if Biden wins, that he rolls back the Trump taxes, and then we have an increase in income taxes. Now, I think there's a couple things we do have to remember. We are in a recession. It's really hard to raise income taxes in this type of environment. And at the earliest, we'd be looking at 2021 once he takes office. But again, that would have to be something that's delicate depending on how things continue to evolve with the virus. But I think the more obvious area where we're going to have a change as far as taxes is concerned is with the state taxes. So the $11.4 million exemption per individual is by far the highest it's been in history, but also even in the recent past. So if you think of when it was the estate tax exemption was $1 million per person, it was just in 2011. So it hasn't been that long. And I think there's certainly a huge risk that we are going to move back, not just back to 5 million, but do we even go lower than that? So this is a great opportunity to be having discussions, because the IRS has come out and given guidelines that they are not going to claw back any planning that's done while the exemption is at 11.4. So this is a great time over the next few years to really look at estate planning and to think more strategically about long-term how to save taxes for your family. So I think that's definitely an area that we've got to watch with the election.
Thank you so much, Leah and Adrian. That's very helpful. So Adrian, touching on the comment that you made about the Fed Reserve, I think last month Chairman Powell said that they're not even thinking about raising interest rates right now. So how long do you think we can have this low interest rate environment?
Probably until well after I retire. I think it's a good question. As I said, it's very hard for them to raise interest rates, especially in the front end of the maturity spectrum in the near term, because of the negative impact that would have at a time when markets and personal balance sheets are still very fragile. So in the near term, anchored is the name of the game. That's in the front end. We might see, as growth persists, that the 10-year Treasury rates start to rise, or the 30-year Treasury rates start to rise, and to some degree, not excessively, because those are predicated on inflation. And so interest rates can remain low as long as inflation remains low. Until we really see the whites of the eyes of inflation, it's going to be hard for them to rise significantly. Second part of that as well, it's when you consider our debt load at the United States, and of course the central bank balance sheet, and what that means um, for our central bank balance sheet when interest rates rise. When interest rates rise, bond prices go down, and because of that erodes our balance sheet, and it makes it more difficult for us to refinance our debt obligations and finance deficit spending. That's almost once again self-reinforcing. It will be a while before we see a rise in, certainly in the policy rate. A while meaning years, I do believe, before we see a rise in the policy rate. And then intermediate rates, they could rise some, but that's going to be predicated on inflation, and we don't see inflation before, but at a minimum, the latter part of 2021, and potentially much further off.
And just to interject real quick, yeah, because I think you can actually even tie that into corporate America, because 60% of all U.S. corporations have triple B rated debt now. So you cannot just, so certainly tying into the deficit in the U.S., but corporate balance sheets are also the worst that they've been in about a decade. So yeah, I think all that certainly ties together. Lower interest rates are going to allow a better repair of everyone's balance sheet.
Agreed.
Thank you. I totally agree with both of you that we'll probably see low interest rates for a long time. And then just to build on that, and this is going to be my last question, is how concerned are both of you about the growing deficit? Because, with low interest rates, we have to also worry about the growing deficit.
Sure, I'll start and say that the growing deficit is large, and getting significantly larger, where we were going to 4+ trillion of deficit spending this year, and then subsequently looking like next year as well. And so adding to our debt load, where expectations for us to be upwards of 120% debt to GDP by the end of this decade, which is a significant debt load, and puts us in the realm of those economies that have trouble managing it in the longer term. Key though is, with low interest rates, with muted growth and inflation, we don't really have that much concern around that deficit spending in the near term. In the medium term and the longer term, yes, there's only a couple of ways to pay your deficit back, sorry, your debt load back. One of those is to grow yourself out of your debt load, which is what many companies try to do when they leverage up, and many succeed. As a country, a little bit more difficult, and certainly when we see the environment that we are in now. The second one is that, one of those is that modern monetary theory, that we print enough money to put out into the environment to, number one, incentivize inflation, and number two, help pay our debt load. We're moving closer to that kind of paradigm. The third one, of course, is that you tax your populace further in order to pay down your debt load. And of course, when you do that, that restrains growth. And so there's a natural balance of those things that will make it, in the medium and longer term, harder to navigate that debt load. In the near term, it's not something that is a major concern. And the Central Bank of Japan actually came out a couple of months ago now, and someone in their meeting asked the central bank governor, well, what are we going to do about this debt load? It's not just the United States, it is globally that we see this issue now. The central bank governor's response was very much shoot first, ask questions later. We don't have the ability to not provide fiscal stimulus to the market at this point, because our way of life and how we navigate this could be changing significantly. So we'll start to think of the policies in the future of how we're going to manage. For now, let's just make sure we support our economy.
And I think your second point in particular, as it relates to the Fed expanding or the Treasury is expanding its balance sheet and having additional liquidity, is what people kind of tie automatically to inflation. And I definitely I think this environment is going to be deflationary as opposed to inflationary. And I think that's where some confusion comes up when you talk about the deficit, when people talk about the deficit, and it's just hard to fathom a situation where there is going to be overall inflation, if it happens, it would have to happen way down the road. It's amazing just to walk around and look at the economy and kind of see what's happening, and more people getting used to staying in. I think you talk about it, it takes 3 weeks to develop a new habit. And I think people have developed new desires to stay in and cook inside and wear a different clothing. You know, you look at, go online, look at department stores and see what sales look like as far as clothing is concerned. I mean, less people are buying very differently than they were buying 6 months ago. So I think this true deflationary, and you see it in used car prices as well, but this true deflationary environment, I think will persist for a while. And I think this is going to be more similar to like 2008, 2009 from the perspective of we had so much stimulus that happened during that time, but it went into holes. It went to fill gaps. And then back then it was the banks and the financial systems. And now it's more individuals. You don't have that whole multiplier impact that you traditionally had, like in the 70s when you had inflation. So it's going to be interesting, but certainly solving the problem with the deficit or curtailing the deficit some is going to be something we have to address in future years. And again, I get back to estate tax is an easy way to start to address that. And I think that's an area of risk.
These are all the questions I had. Thank you so much, Leah and Adrian, for your insights. Thank you, everybody, for joining us. Please feel free to reach out to your advisor if you have any questions. We hope you have a wonderful rest of the day. Goodbye.
Thank you, Maria. Thanks, Leah.
Thank you, Maria.